As the world pushes through the second half of 2022, the financial market continues to navigate through a series of macroeconomic stresses and challenges. Although this does make investment a generally riskier venture, it does not stop financial traders from seeking out the next golden opportunity. With the state of the markets this complicated, it really comes as no surprise considering that investors are presently struggling to identify which stock they should invest in, and which they should steer clear from. To make matters worse, the recent bear market spectacle has most stocks, even market giants, trading significantly below their prices of a year ago. This further adds difficulty in distinguishing winners from losers. In this spirit, we bring forth a video list that covers 5 optimal stocks that you could consider adding to your portfolio for August 2022. These stock recommendations are ideal considering the present market conditions, and cover a range of different industries of the economy, whilst offering unique strengths in terms of their investment value. Up first we present the software champion, Palantir Technologies Inc, which trades under the ticker, PLTR. Palantir Technologies is most well known for providing high-capability software tools and platforms to American intelligence agencies, whilst assisting in counterterrorism operations. Palantir holds a very dominant position as one of the government's favorite contractors. Its services are used by critical U.S. security agencies, which include FBI, CIA, NSA, and DoD. Similarly, its software remains critical to the functioning of the UK's National Health Services, and the US-based Food and Drug Administration. This crucial role in so many critical domains makes the stock largely recession-proof. This is especially since 55% of its clients in 2021 consisted of government agencies. Palantir is typically perceived as being a controversial stock, primarily due to it still being in its pre-profit phase. For this reason, the stock took a severe beating when the market entered into a bear category. In the 8 months that followed October 2021, PLTR had plummeted by a shocking 80%. Since May of 2022, however, PLTR has been observed to have entered its recovery mode. The sharp drop Palantir experienced is part of what makes the stock so attractive. The plummet does not match up to the strong growth prospects inherent to the company, which means a price correction is imminent. Those that identify this early on are likely to benefit quite substantially. The most obvious indicator for this is the fact that PLTR fell 55% in the last 12 months, yet its recent quarterly revenue figure indicates an over 30% year-on-year growth. Moreover, during the same period, its overall customer count grew by an impressive 86%. Palantir is a high-growth company, which is why its unprofitability is not a major concern as of yet. Once the company begins turning in profits, the rise will be exceptional. Market panic has made the stock, perhaps the best investment opportunity for upcoming times. Next up on our list is the Oregon-based automotive dealership group, Lithia Motors Inc, which also goes by its ticker of LAD. Lithia Motors is yet another example of a high-promise stock, the price of which the market drove down in its panic-induced frenzy. Lithia is a company that is on an epic growth trajectory, as indicated by both its financial rise as well as its aggressive acquisition strategy. The company has embarked on its acquisition-driven expansion since 2021, when it had invested over $2 billion in the purchase of 77 retail stores. This year, the company further added 9 Lehman Auto World stores, along with 2 Esserman International stores in Miami, Florida. This aggressive growth strategy is part of Lithia's strategic goal of attaining $50 billion in annual revenue by 2025. Moreover, Lithia Motors' financial results further indicate it is well on its trajectory towards its lofty target. In just the first quarter of 2022, the company reported revenues of almost $7 billion, which came at a 55% increase since the prior year. For a company climbing at such a rapid and exponential rate, demand for its stock should be surging. However, this is not the case. LAD's price fell by over 21% in the last 12 months, despite such strong fundamentals. The valuation of the stock alone makes this a screaming buy. Those that buy and hold LAD now can expect a rocketing growth surge as panic dissipates from the market. Before we proceed to the next stock on our list, we hope the options presented in this video so far have been insightful. If the list has proven beneficial to you so far, do subscribe to our YouTube channel and turn on the bell notification. Furthermore, we also offer a morning newsletter to our email subscribers. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If the list has proven beneficial to you so far, we would appreciate you clicking on the like button to show your support. Up next, we present the S&P 500 Urban Office REIT, Alexandria Real Estate Equities Inc., which holds the ticker ARE. Given the present market circumstances, a REIT is almost a must-have for your August 2022 portfolio. ARE in particular is a stock that is well positioned to climb throughout the rest of 2022, and potentially beyond that too. Alexandria Real Estate is a REIT that leases its urban office real estate to agricultural tech and life science tenants. At present, its portfolio consists of 42 million square feet of rentable space in some of the most high-value real estate areas of the United States. It holds the bulk of its properties in New York, the San Francisco Bay Area, San Diego, and North Carolina. Moreover, at least 50% of the REIT's rental income comes from either high market capitalized publicly traded companies, or those that are investment graded. This points to the strength of ARE's balance sheet, as well as the quality of its tenants. Moreover, in a market defined by inflationary price hikes and the fears of a recession, an asset-backed stock such as ARE is probably the best route to take. Another aspect inherent to ARE that makes it quite an attractive buy is its dividend structure. The REIT pays out 57% of earnings as dividends, as would typically be expected of a large real estate player. Its dividend yield amounts to an impressive 3.2%, and the dividend payment has been consecutively increased for the last 12 years. ARE boasts extremely stable earnings and robust overall fundamentals. Considering its price has fallen by 25% in the last year, now seems like a great time to buy this stock for one's investment portfolio. The fourth stock on our list is that of the home furnishing industry's giant, Leggett Platt, which is also referred to as LEG. In addition to furniture products, LEG also plays a crucial role in vehicle components, which gives it a diversified product mix. Some of its customers include Walmart, Home Depot, Ford, and General Motors. The company's aerospace and hydraulic cylinder segments have each been seeing steady growth in recent years. In addition to its product diversity, Leggett Platt is also diversified in a geographic sense. Its primary market is the United States, yet it also holds a significant presence in Europe, Mexico, Canada, as well as in China. Consumer markets typically stand largely exposed to macroeconomic stresses and wider volatilities, yet LEG remains safe owing to its strategic market diversification. It is partly due to this reason, the company had maintained its dividend king status even during the worst economic circumstances, such as the COVID-19 outbreak. LEG achieves growth both organically and through strategic acquisitions. The last 5 years saw the company's revenue climb by a compound annual growth rate of 6.5%. Moreover, LEG's dividend payments not only yield an impressive 4.6% at present, but have also been consistently raised without fail for the last 51 years. The stock represents stability, and is precisely what an investment portfolio should hold throughout the remainder of the year. The final stock on our list, yet far from being the least, is the global energy and petrochemical giant, SHEL plc, which trades under the ticker SHEL. Petrochemical companies presently find themselves in the middle of an identity crisis, with the world in a transition mode towards clean energy. Last year, the largest EU pension fund, ABP, dumped about $17.4 billion worth of fossil fuel assets, owing to the unsustainability of the industry amidst a worsening climate crisis. In the wake of this, SHEL has taken a revolutionary approach, and is positioning itself to lead the global green energy empire of the future. It is heavily investing in restructuring its business model, whilst aiming to operate 500,000 EV charge stations by the next 3 years. This exposes the company to a booming EV market, which could bring in growth as high as 17.5% per annum. Even more impressive is SHEL's plans to develop Europe's largest hydrogen plant, in the wake of the continent's energy security program. This sustainable energy move could bring in the company an annual hypergrowth rate of 54%, continuing through to 2030. SHEL is an extremely financially successful enterprise that has the means to transform itself for the future. Its balance sheet reports almost $40 billion in working capital, which could see the company soar as a green energy champion, in a transition that could see fossil fuel players dying out. Moreover, SHEL also enjoys a century-old globally renowned brand, which is sure to give the giant a much-needed boost in its new ventures. The long-term value of SHEL remains extraordinary, which is why the stock stands as being too good to be overlooked. This growth potential makes the stock an immediate strong buy. That's all from us in this video. We hope the insight we aim to deliver has proven valuable to you, and would allow you to ensure your portfolio is well suited for long-term growth. We would love to hear your feedback about our list in the comments below. To gain a deeper insight into different stocks that are fit for various investment strategies, be sure to check out our website, stockstelegraph.com.